first guest for the show. Dhiraj Sachdev, the managing partner and CIO at Roha Asset Managers, is joining in now to talk market fundamentals and his top sectoral picks. Dhiraj, good morning. Thanks a lot for joining in. I guess now with this political continuity and all this uncertainty around it out of the way, there was this dramatic shift in narrative around PSUs after the election results, and suddenly almost every participant on the street who was extremely gung-ho until the exit poll results suddenly turned extremely cautious. Some of them even exited their positions, some cut their weightages. With the current government now back in shape the way it was, does the narrative change again, or with the focus now shifts back to earnings growth and some more fundamentals?
Hi, good morning, Hormaz. With government's portfolio distribution across ministries, it is now very clear that policy and reforms are likely to continue. Now, given the earnings support, rising retail equity culture, or global flow and government's announcement with respect to roadmap for the first 100 days, it is highly probable that market will sustain rally to a pre-budget euphoric peak before a prolonged consolidation or lull phase sets in. Now, the continuity of reformist government is being anticipated by the market, and along with better earnings growth will be the drivers that will push markets to higher levels. Now, broadly, we remain positive given strong capex from government side across sectors of the economy like infrastructure, besides thrust on improving manufacturing cycle and ongoing reforms in the power and renewable sector per se. Besides, rural focus is being anticipated like low-cost housing, agriculture, and provision of drinking water for all. And these will only gain momentum in times to come. So, and government has the bandwidth now to fund such large capex or undertake fiscal expansion by PSU divestments or RBI dividends or higher tax collections. So there are structural changes. As you mentioned, on the PSU side, there are PSUs in defense, where the procurement with focus on local manufacturing and huge acceleration in capex on railways, electronic manufacturing services that can be witnessed over the next decade. So there is a long runway to growth. Our stocks in the segment of defense, railways, EMS may have largely moved ahead of time or have given upfronted returns far ahead of their earnings. So one has to be cautious in these spaces in the near term and elongate investment holding period now to say beyond 3 to 5 years, as the business outlook and earnings growth appears to be durable, but a lot of earnings are already getting discounted upfront. On the other hand, what we like are the sectors where the market is completely or not discounting fully, which are worthy of investing, include financials, pharma, agriculture-related sectors, cement, or select infra construction companies, including engineering companies, where their margins have bottomed out and they are not fully discounted in terms of earnings growth potential. Hence, these sectors would be preferred compared to railways, defense that you talked about on the PSU side.
Got it. Dhiraj, hi, good to have you on the show today. So again, continuing with Hormaz's question, the other major narrative that we saw over the course of the last week was that, okay, this government will start being a little populist. It will spend a lot more than it has in the recent past, and therefore you need to be with rural-facing themes. So therefore, there was this big move towards FMCG. What did you make of that, and do you still agree to it to some extent? And how are you looking at bottom of the pyramid consumption? And if at all you would want to play it, it would be through what kind of companies and stocks?
Yeah, hi, good morning, Surabhi. So there is obviously hope for revival in consumer-oriented sectors led by better monsoons as La Nina takes over, and also based on expected rural thrust in the budget. So obviously we can expect some possibility of social expenditure which will continue. And government's even socialistic expenditure was continuing, like Har Nal Se Jal. There were a lot of water pipeline companies which have done extremely well on the earnings side. Housing finance companies on the low-cost housing, affordable housing, where they are talking about building almost 3 crore houses. So there are a lot of these pockets which are already being continued, which are already existing from the government's capex program or socialistic expenditure. And not just that, now there is a coalition government, there will be more renewed thrust. So I think these things will continue and sustain going forward. And added to the fact is there will be better monsoons, which will revive some consumption demand. So consumer durable could be one of the places. Housing finance companies that I talked about, the pipeline companies, the pipe companies that provide drinking water, sanitation, etc. Building products companies with boost in the affordable housing segment, etc. are the spaces that one can look at.
And speaking of underperformers, the other space that has been a rank underperformer in the recent past is specialty chemicals, Dhiraj. But some of the data that has come in for the month of May, now that the Phillip Capital note that says that the volume-led growth has continued in the month of April and May as well, and that contributed to the highest ever exports in the fourth quarter of FY24, which is so it's a continuation of that. Now, at these prices, Dhiraj, do you think that okay, the sector has been an underperformer? We can take a bet on this, wait for a quarter or two before things change, and then it starts to show up once the cycle turns.
Rightly said, specialty chemical sector in the near term has been passing through inventory destocking issues, resulting in lower export demand. But we are seeing that pickup is happening. And the worst of the margin of the pricing competition from Chinese players, especially the imports, has been pretty aggressive prices, and that has affected the domestic manufacturers on the chemicals and specialty chemical side. So I think that destocking phase may be over, and the worst may be likely behind, though the time and the pace of recovery remains uncertain, given limited visibility on the extent of inventory levels across various parts of the channels and unpredictability of Chinese players' pricing strategies. At a broader level, export growth should likely begin to normalize by over the next 2 quarters. So the stress of demand conditions and margins are close to bottom and will only improve going forward. So structurally, the sector will continue to benefit from expected and gradual China plus one strategy to have India as an alternate supply source. And importantly, new project capex appear to favor either backward integration or import substitution or new molecules with export opportunities in this sector. So obviously, one can be a contrarian, and the worst of the margin cycle may be behind.
Okay, got that. So, what should the portfolio strategy be, Dhiraj? I mean, overall, just give us your bird's eye view. Which would be your biggest overweights right now? You know, if there's a churn in the portfolio that you're looking at, given that we're at all-time high levels, just run us through the strategy.
So what we are having is in the portfolio, we have financials, which include private financials, NBFCs, where I think after the recent RBI diktat, the valuations have become attractive. It could be microfinance, housing finance companies, or some of the SME finance companies on the NBFC side. Pharma is one particular area, be it either domestic or some of the export opportunities that we have taken as an exposure. Agriculture theme, I think that can also turn around. So whether it's agriculture-related sectors, including agrochemical companies that we talked about, can see some kind of a margin bottoming out. Cement and infra construction sectors are the ones that we have part of the portfolio. So I think there are a lot of plenty of spaces to play on, including some of the selective manufacturing sector companies. And the portfolio can be filled up across these diversified businesses to play.
All right, Dhiraj, we'll leave it at that. Thanks a lot for sparing time and joining us today and sharing with us your sectoral preferences and the road ahead for the markets as well. That was Dhiraj Sachdev there of Roha Asset Management.